The views expressed in this video presentation are my opinions and not necessarily the opinions of guests and others sharing or reposting this video. The content is produced only for educational and informational purposes. Do not regard any statements in this video as a recommendation to buy or sell any financial instrument. Investing comes with risk to loss of principal. Always conduct your own research and seek guidance from a professional investment advisor. I am not a professional investment advisor. I'm Dollar Will. Let's make some money. All right. Today, we're going to talk about the S&P 500. Keep it basic like that. Let me just announce that I have a Patreon site I just opened up. I haven't done a whole lot to promote it. There's not a lot of stuff there, but it will be. No sense putting stuff there. No one's there yet. But the people who get there early, they will get individual consultations and stuff like that. Since it's so small, I'll be able to do private hangouts with them and give them more information. But this instrument today, the S&P 500, is so crucial to Americans because most of the retirement accounts are pegged to this instrument right here. This I have to give away for free because of the severity or the importance of this instrument. What we're looking at is a weekly chart, and the low here is from 2009. This is around 2007, 2008, where the big crash happened. So quote unquote big crash, which is really nothing in comparison to the crash that I maintain we're already in. What you see here at the bottom is a support moving average. I'm sorry, a support line. And it's doing just as it says, it's supporting the price. I am a proponent of Elliott wave theory, and the core principle of Elliott wave theory is that prices move in a 5-wave count and then they correct. And the correction is a severe downturn like this. And in this particular one, I maintain it would be even greater. Okay. My thesis is best explained in the video from January of 2018, where I took a view of more than 100 years. I explained Elliott wave theory. I showed the wave count, and I was wrong in January when I called this at the top. But we see that in October, it ended up happening. So Elliott wave theory is not exact. There's no technical analysis strategy that is exact. Okay, you can get close. You can put the odds in your favor, but no one can call the tops and bottoms in the market to the day. Now, that's true, but don't let people think that you can't get close. So I hear a lot of people who are not technical traders say that nobody can time the market, and they leave it at that. Well, that misrepresents the truth. Because I can't time it exactly doesn't mean that I can't get close enough to protect myself from great devastation. And so that's what I'm offering you today. What we have here is my view of the Elliott wave count would be: this would be wave 1, this would be wave 2, this would be wave 3, that would be wave 4, and this is 5. You'll notice in this 5th wave, I have another support line, and this support line here also has a 5-wave count: 1, 2, 3, 4, 5. This subwave within the 5 is called a fractal, and that's another key principle to keep in mind about Elliott wave theory. Think of this small wave as the child, and think of this big wave as the parent. Okay, and within each of these 5s, you could zoom in and you can see 5 inside of there, and so on. I'll address that later in other videos designed to go deeper into Elliott wave theory. But you got the main point. So once you see the structure start to form and you put a support line, you're looking for the price to maintain the trend above that support. Now, this high here was September. Yeah, the information box to the left there says around September of 2018 is when we started the decline. And you'll notice that the price, although it took a steep dive, it did not violate the support. No, as I said, Elliott wave theory has 5 waves up, but the down moves are ABC patterns. So we count 1 through 5 like I did when I counted the 5 waves. But on the downturns, we count these as A, B, C. And so the fact that we have an ABC pattern right here, that that's kind of helping me offer me some reassurance that my wave count is right. You will also see here the retrace A, B, C. Okay, so that's just giving you how to do the wave count. Now, in technical analysis, there's a common saying that support becomes resistance. So we see this moving average here offering price support. Price fell through the support, rose back up to the general area of the resistance, and it looked like it's falling again. I'm going to zoom in and show you a little bit closer here what the cause for concern is. A fundamental principle of trends is prices make, in this case, we're talking an uptrend. We're talking from this low, which is around Christmas Eve, to I believe this high. I'm looking at a weekly chart, but if this was a daily chart, I believe this was Monday. I believe this high was Monday. So we had a trend that ran from Christmas Eve until just 2 days ago in the S&P 500. And in that time, people were, in my opinion, lulled into a false sense of security that the trend had resumed, the uptrend had resumed, that there's no more cause for concern. I'm doing this video to disvalue of that view. As you can tell, I don't do videos often. So if I do a video, you need to watch it. Hit the bell if you haven't. If they're friends of yours that you want to kind of keep them tuned into the market, you want to send them this. I'm not going to be doing a whole lot of stuff. So if you see me doing a lot of videos, a lot of chart videos in a short amount of, say within a week, that means there's something special going on in that week. It's a lot of confluence of a chart activity, price activity, that is a key moment for a lot of reversals in the market. Okay, so what we'll notice here is each candlestick, these are called candlesticks. Each candlestick, the low is lower than the previous candlestick, like walking up steps. Okay, stepping on a higher step, each one. Every candlestick is a higher low. Also, the top of the candlestick, the peak, every high is a higher high, like walking up steps. I don't know if this was a higher high. Let's see. This high was 26.75.47, and this is 26.72. Yes, it was. No, it wasn't. This is 26.75. This is 26.72. No, it wasn't. But it still was close. It made a higher low. So what you're looking for, what would cause you concern if you're trying to ride a price trend higher, is if a lower low is made. Now, again, I'm looking at a weekly chart. So across a week, of course, in trading would be 5 days and not 7. So if across 5 days the price makes a lower low, that could be indicative of, let's say, back out here to these 5 waves. Let's say if you're in one of these downturns where it's going to continue up, like one of these fractals, let me use the correct word. Now we know what it is. If I'm inside of one of these subwaves called fractals, and it starts making a lower low, that could be indicative of just the short term downturn in a fractal. But once you complete a set of 5, that changes everything. And and if we have completed a 5 here, so this whole 5 is a set, and this is the 5th wave of 5. Remember, we counted from 2009 to now. This is wave 5 of 5. And we have a stochastic oscillator here, which is measuring the price momentum. So we went from anything above 80 on the scale is considered overbought. That means that we've had a lot of price movement, and within a pretty short amount of time. And so prices just kind of ebb and flow naturally in this oscillator, and gives you an idea that, okay, we've had about as much price appreciation as we're going to get for this part of the wave, and a natural downturn is normal. So you'll see all these natural downturns here, but the trend maintained. Now here, this fractal, we had some selling pressure, and it violated the support. I maintain that when we flip and we go from overbought, where we are now, down to oversold, that just as once we complete, I'm looking at this fractal of wave 5, just as after we finish fractal 5, which is 1, 2, 3, 4, 5, just as upon completing 5, we crash through this support, I maintain that we're going to have this is A, B, and the C wave is going to crash through this support. But when it crashes through, it's not going to continue higher to go on to make new highs. That instead, we're going to correct this entire trend that started in 2009. Again, I'm not a financial advisor. This is just my personal opinion. But keep this in mind when you hear other people on the stock shows preaching a doom and gloom. I'm telling you, there's a lot of sound technical analysis theory that is proven true over a century. Okay, supporting the view that the downturn that we have been experiencing since September. That's just it. I have to remind you, we've already been in it since September. It's just that this rise since Christmas Eve has lulled you into a false sense of security to make you think that it's over. But we'll see as this flips. But there's a lot of information out there that suggests that this downturn that we have been in since September will be as great as the one that we call, quote, the Great Depression. Okay. And because in Elliott wave theory, just look again, just as this wave here is a fractal or a child of this parent wave that began in 2009, this fractal in 2009 is a child of the wave that started sometime around emancipation. Okay, and I call this the slavery trade. Okay, so this whole movement that in prices in markets that we've experienced since emancipation is all one big trend. And in Elliott wave theory, wave 3 is the most powerful and most profitable trend. So where are we if this is 1865 or in the late 1800s? I don't know exactly where that bottom is. I think I make reference to it in that video from January 2018. I believe it's the first video I ever posted, and I can give you a better idea of when this trend started in that video. But the point of the matter is, let's just say this was 1865. This got us to the late 20s, and this started the drop for wave 2, what we refer to as the Great Depression. And so from the early 1930s, which started the recovery, We've been in wave 3. Let's say this peak right here is September of 2018. So this would be like 1930. This would be this past September, and this correction we're getting ready to do right now is wave 4. Okay, so I know this is freaking y'all out, but so right here is the end of wave 3, and we're going to have a pretty severe correction. So just keep your eyes focused on this. Now let me go in a little further to show you on the daily chart what I am doing. This will make more sense when you watch that video from January 14th, I think it was, 2018. So now I went to a daily chart, and we're looking at just that rise from this actually was December. Look at the information about it. It was December 26th, not Christmas Eve, the day after Christmas. The high of the trend was here, which was the 4th. That was Monday. Okay, I'm gonna show you, teach you a little something that caused concern, a technical item that is a concern. Okay, forget this candlestick for the moment. Forget these 3 red candlesticks for the moment. Prior to these 3 candlesticks, the high was the 25th of February, and the high was 2813.49, and the low was here on the 27th, and the low was 2775. Now this red candlestick is called a bearish engulfing candlestick, and it's also referred to as an outside move. What is significant about this candlestick is this one candlestick created a new high, which is Monday. This represents Monday. This big red candlestick represents Monday. It made a new high and a new low all in one day. That's what happens when big money shifts and starts rotates its position. So this bearish move engulfed at least the extremes of the bullish move, which represented the high for the trend. So a lot of short positions, like that's people betting against the market. Short positions begin with buying the stock. Basically, in a short, you're borrowing the shares from the broker. So the broker has to go buy the shares that you're borrowing, and you're basically going to pay the broker back the shares later. but you only have to pay, you have to give the shares back. You don't have to give the value of the shares back. It would be like you borrowing my Mercedes Benz and you driving it for 10 years and you bringing it back to me in 10 years, but you don't have to pay me back for the depreciation of the value of the car. Okay, it's a flipped way of thinking, but that's basically what shorting does. But the point of it is that process of borrowing the shares or initiating a short position by your broker going out and buying the shares that you're borrowing from him causes the price to artificially go high, which is a sucker move. And the fact that it turned around and went lower, that tells you that although it made a high, that high was not a sign of genuine enthusiasm for the market. In this case, because it's a bearish candlestick and an outside move, it tells you that it suggests that this move was pessimism, not optimism. So you had a low here, and we violated it. And today's candlestick looks like we're going to continue on down. So just as we were making higher highs going up, now we're making lower highs. Okay, and we violated the trend line. So this is what you need to keep your eye on. So everybody that wish they had sold at the top of the market, let me see where I can find that. And our oscillator here is showing the move from right around Christmas to the overbought area. So we're definitely overbought, and we'll see how low it goes as we go from overbought to oversold. If there's enough enthusiasm in the market to keep the price above the trend line, support trend line, I wouldn't bet on it. For me, when I don't own this stock, but if I did, I would get out and I would watch to see what it did. For people that want to be more aggressive and want to find out how to actually make money in the market, you're gonna have to join my Patreon. you know, I can really show you some stuff on that. So that is the real alert that I wanted to bring everybody's attention to, because on the news, a lot of they have a way of telling you what's going on. One, not this clearly as I just did, and telling you when it's too late. Okay, all right. So if you watch those shows on CNBC like Fast Money and James Cramer, if those are the things that you watch occasionally, well, this is a week that you should watch it every day. You'll be able to read between the lines, because there will be some people on there sounding just like me, sounding pessimistic like me. And then there'll be some people on there cheerleading, saying, everything's good. By listening to what those countering opinions are on that show, combined with my more detailed breakdown of what's going on, you'll be able, and combined with talking to your financial advisor, you'll be able to reach some more a more informed decision about what it is you want to do, how you want to play this.